Now we start from the step 2, project operating expenses and derive operating income. In this step, we are going to forecast several elements of operating expenses: cost of goods sold, SG&A expenses, and other operating expenses. Okay, so these are all deductions from the revenues. So when you forecast them, you should pay attention to their sign. Okay, we are going to use the results from step 1, the dollar amount of future revenue from year +1 to year +5, and the growth rate for the 5 years. And if we switch to the forecast tab, you can see Excel already referred the dollar amount from the forecast development. Okay, but we still need the growth rate for revenue, so I copied this to here. Okay, so I changed the format to percentage and show more numbers. Okay, so now we have the forecast revenue from year 1 to year 5, and the growth rate from year 1 +1 to year +5. The reason I keep the growth rate because some items or some accounts in either income statement or balance sheet shares the same growth rate with the revenues. Now we forecast the first item in the income statement, cost of goods sold. Okay, so for cost of goods sold, we usually use common size analysis to forecast the cost of goods sold. Okay, the common size analysis is the information in this row. Okay, so from year 15 to 16, on average, the cost of goods sold is about 60% of total revenue, right? So we just simply assume the total revenue is about 61% of the total revenue. Okay, so here we apply the common size analysis. So the cost of goods sold actually is what is from is a product of revenue and the percentage of revenue. Actually, common size analysis, right? But here we should be careful. We need to use negative sign for each item. Otherwise, the cost of goods sold will be added up to the revenue. But we should deduct cost of goods sold from revenue, right? So after this step, you will find we get a gross margin or gross profit, which is the difference between revenues and the cost of goods sold. So the gross profit margin is about 39% of the total revenue. So that means if Apple make $100 revenue, it also make $39 gross profit. So similar as cost of goods sold, we can forecast SG&A expenses in the same approach. Okay, because SG&A expense usually is a fixed amount of the total revenue. So if you see the common size analysis, the SG&A expense is about 6.1 to 6.6%. Okay, so the recent year 6.6%. So we keep applying this percentage as the forecast of SG&A expense. Okay, and the next one is other operating expense. For Apple, there's only one item available. That's research and development expense. And let's take a look at this item. From 14 to 16, the dollar amount keep increasing, right? Like 33.5% increase, 24.5% increase in 2016. So that's a large increase, right? And the common size analysis, also shows the increase from 3.3% of total revenue to 4.7% of total revenue. And we see the increasing trend. So I just assume, the total research and development cost is greater than 5% because it keeps increasing, right? So I just simply use 5%. Okay, also you can use a different number, 5.2, 5.3, or 5 in year plus 1, 5.2 years in a year plus 2, 5.3 in a year plus 3. It's up to you. Okay, but it just shows that there is an increased trend of the R&D expense. Okay, right now we have no other items for the operating expenses, because these are all zero, right? So we just simply assume the Apple will keep them the same trend, like zero for the future. So after these steps, we got operating profits, that's dollar amount, and the operating profit margin, about 37.4%, and the rate of change. And don't forget, this should be negative, right? So I change the sign to negative 5%. So the expense are negative.